Good morning and thank you for joining my latest fixed income research and macro strategy research presentation. The topic I'm going to be focusing on today is one that's been in the press regularly in the past year, and that's emerging market central banks' FX reserves, namely the firepower that these central banks have to defend their currencies should they come under pressure in coming months, particularly around the June Fed policy meeting. A year ago, I argued that market concerns about the level and the direction of these reserves was overdone. And I'm reiterating my view today that FX reserves in emerging markets remain sizable despite their modest decline since a peak in the middle of 2014, particularly when we take into account currency valuation effects and we look beyond China and commodity exporters, which have seen more sizable fall in their reserves. It's also worth noting that in March, FX reserves in emerging markets rose across the board on the back of stronger capital inflows. Also, whilst there's been a lot of focus on countries where reserves have fallen, it's worth noting that reserves are actually up from the middle of 2014 in India, Korea, Taiwan and Thailand. And you can see this in figures 1 and 2 on the slide. Having said that, I do acknowledge that there is a differentiated picture when we look at a country-by-country picture. FX reserves, broadly speaking, are large in non-Japan Asia, bar Malaysia, India, and particularly Indonesia. FX reserves are small in most of Latin America and in major African economies, including Egypt, Nigeria, and South Africa. This differentiated picture is likely to continue influencing the ability and the willingness of central banks to slow, let alone stop, currency depreciation by intervening in the FX market. So let's dig a little bit deeper. The dollar value of emerging markets FX reserves has fallen by about $1.1 trillion in the past 20 months to roughly $7.6 trillion in February. That's an average monthly fall of around 57 billion US dollars. But, and this is an important but, reserves are still $2.3 trillion higher than before the 2008 Great Financial Crisis. Put differently, emerging market central banks have used up only a third of the FX reserves which they accumulated between September 2008 and the middle of 2014. I want to talk about FX valuation effects because these materially impact the picture of reserves in emerging markets. Currency valuation effects, effectively the dollar's appreciation versus other reserve currencies, account for nearly half of the fall in the dollar value of reserves since mid-2014, as we can see in figure 3. The US dollar's appreciation versus the euro, yen, sterling, Canadian dollar and Australian dollar cut the dollar value of these reserves by about $515 billion. If we adjust for these valuation effects, emerging market reserves fell only $626 billion between June 2014 and February 2016. That's an average monthly fall of only $31 billion, or roughly 0.35%. So valuation effects are material. What I want to do now is to look at emerging market reserves outside of China. Chinese reserves fell $790 billion between June 2014 and Feb 2016, as we can see in figure 4. That accounts for 70% of the fall in overall EM reserves, as depicted in figure 5. If we exclude China and we adjust for the valuation effects which I've mentioned, emerging market reserves fell only $52 billion, or 1%, between June 2014 and February of this year. At a regional level, reserves fell roughly $260 billion in EMEA. They rose $11 billion in Latin America and rose $154 billion in non-Japan Asia. Perhaps unsurprisingly, the fall in EM reserves has been concentrated in commodity exporting economies, namely Malaysia, Nigeria, Russia and Saudi Arabia, as well as China, as I have already mentioned. And we can see this very clearly in figure 7, which looks at the estimated change in these reserves in the past 20 months, both in raw terms and adjusting for valuation effects. As I've mentioned, reserves in March rose materially in countries where we already have March data. Specifically, these reserves were up roughly 0.5%. If we exclude China, reserves in the month of March rose over 1%. And importantly, it was a very broad-based increase in the dollar value of reserves. Yes, they fell in Armenia, Hungary and Ukraine, but they rose in all of the non-Japan Asian economies: Belarus, Bulgaria, Chile, Colombia, El Salvador, Georgia, Kazakhstan, Poland, Romania, Russia, South Africa and Thailand. This likely reflects in part stronger global risk appetite and net capital inflows into EM economies in the past month. And again, this is depicted quite clearly in figure 8. As I mentioned before, despite what I think is a ultimately benign picture for emerging market reserves, it is a differentiated picture. Reserves are modest in Africa and Indonesia and parts of Latin America. Specifically, reserves are small in the main African economies, Egypt, Nigeria and South Africa, as well as Poland, Romania and Turkey in EMEA. In Latin America, they are modest in Argentina, Chile and Mexico. And in Asia, Indonesian reserves are still small. Reserves remain pretty modest in India as well, despite the increase we've seen since the middle of 2014. And you can see this quite clearly on figure 9. Chinese and Russian FX reserves are average as a percentage of GDP, but large in months of imports. And we can see this in figure 10, which looks at the latest numbers we have for central banks' reserves, measured both as a percentage of GDP on the y-axis and in months of imports on the x-axis. Again, there's been a lot of focus on Saudi Arabia's reserves and the large fall that we've seen as a result of lower oil prices. Those reserves have fallen roughly 20 percentage points of GDP, according to my estimates. But they remain sizable both as a percent of GDP and as months of imports. Again, we can see this in figure 10. Taiwan's reserves have risen slightly and are sizable on both metrics. So we've talked a lot about how emerging market reserves are still large in historical terms. But what also matters is central banks' willingness to use these reserves to shore up weakening EM currencies. And whether central banks are willing to use these reserves is an ultimately complex issue. History suggests to me that central banks in non-Japan Asia would likely use FX reserves to fade acute or prolonged currency depreciation. The significant fall we've seen in the dollar value of Malaysia's reserves since the middle of 2014 certainly suggests to me that Bank Negara Malaysia may have sold FX reserves to support the ringgit, which was under pressure from falling commodity prices. China has certainly countered large capital outflows to ease the pressure on the renminbi by running down its reserves, which has run counter to market expectations that the central bank would allow rapid depreciation of its currency or even trigger significant devaluations. As you can see in figure 11, the renminbi has depreciated in nominal effective exchange rate terms, but it's been ultimately a slow, gradual and controlled depreciation. Let's just focus on Asian central banks for a second. Precedent suggests that non-Japan Asian central banks are likely to accept a degree of currency depreciation and certainly fade sustained appreciation as exports and inflation in Asia remain tepid on the whole, while Indonesia's FX reserves are modest. It's this very willingness and ability of Asian central banks to intervene in the FX market and fade more extreme currency moves, which has contributed to a reasonably constrained pace of currency change. Figure 12, I think, is extremely interesting and important in understanding Asia. What it shows, in essence, is a GDP-weighted basket of Asian currencies and how they have evolved on a monthly basis. The latest data shows that this weighted basket of Asian currencies, has been broadly flat versus a month ago and remains very much in the middle of these narrow bands, which are depicted in red. Again, this highlights the degree of predictability, if I may, in Asian currencies. Whilst they remain volatile over longer time periods, this volatility is constrained by central bank action. Now, quite clearly, Japan is not an emerging market economy, but given that we've been talking about FX reserves and also about the willingness of central banks to manage their currencies, I think it's worth turning our attention just for a minute or so to the yen. Now, as the figure 13 shows quite clearly, the yen has appreciated very sharply in recent months and has remained strong despite the recent verbal intervention by the Japanese finance ministry. What I think this shows is that in a country with a widening policy credibility deficit, it's very difficult for policymakers to slow, let alone stop, rapid currency appreciation. Now, this begs the question whether Japanese policymakers will go a step further and actually intervene in the FX market to slow, stop, or even reverse the yen's strength. I think there's a number of tactical reasons why the finance ministry may not intervene in the FX market to weaken the yen. For starters, Japan is hosting the G7 summit at the end of May and may want to avoid suggestions of currency manipulation in the run-up and during this important summit. I think there's a more fundamental reason why the Japanese finance ministry may not yet intervene in the FX market, and that is that Japanese exports have held up reasonably well, even when measured in yen terms, and we can see that on figure 14. Yes, the yen value of Japanese exports has come off its recent peaks, but it's been a modest decline rather than a collapse, and of course this partly reflects currency effects on its own. Importantly, and we can see this on figure 15, the Japanese trade balance, which has been in deficit for the past 5 years, has actually gone into surplus recently. Now, an important caveat. This loss of yen competitiveness since December could start weighing on the Japanese economy and trade numbers in coming months, given the typical lags we have in contractual pricing. If we do start seeing a more pronounced downturn in exports and an erosion of this modest Japanese trade surplus, this could give the finance ministry a more tangible reason to start intervening in the FX market. If, and it is a big if, the finance ministry intervenes in the FX market before the Bank of Japan's policy meeting on the 28th of April, it will have to be an aggressive move to be effective, in my view. Again, just to reiterate, yes, emerging markets central bank reserves have fallen since their peak in 2014, but it's been a reasonably modest decline, and at an aggregate level, reserves remain sizable in emerging markets and in a number of key economies. We have seen in the past, particularly in Asia, the willingness and ability of central banks to intervene in the FX market to smooth more acute, more abrupt currency moves. I don't see any reason why it should be fundamentally different going forward. I've included two slides on the methodology that I use to estimate emerging market reserves and their evolution in recent years. As always, I would be very happy to welcome any questions or comments that you may have, and you can of course access all of my research on emerging markets and other macro and currency themes on my website www.olivierdesbarres.co.uk. Again, thank you for taking the time to watch this presentation, and I would be very happy to answer your questions and queries either on email or by phone. Again, thank you and have a good day.